Ever notice how the rules changed after 2008? We were told, work hard, get ahead. But then central banks started printing money like crazy. The result? Asset prices climbed while wages grew slower. It's the money for nothing effect. Those closest to the financial system benefit win. Everyone else? Left behind. So what's really going on? This video breaks down why it all feels so rigged. Let's dive in.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
August 15th, 1971. Under the blinding heat of television studio lights, sweating through his suit, Richard Nixon single-handedly severed the US dollar from physical gold. He didn't just suspend convertibility, he kicked off the largest, most mathematically precise transfer of wealth in human history. We think we know why the economy feels rigged, why housing is unaffordable, and why inflation keeps destroying the middle class's purchasing power. We think we understand how money works, but we're only seeing half the story. Today, we're ripping away the academic smokescreen of central banking. I'm going to mathematically prove to you how commercial banks create 97% of global money out of thin air, how quantitative easing legally forces your pension to prop up failing corporations, and the exact digital mechanism the Federal Reserve uses to extract 1% of global GDP from the world's poorest nations every single year. You'll never look at a mortgage contract the same way again. After World War II, the global financial system ran on the strict discipline of the Bretton Woods Agreement. Foreign currencies were pegged to the US dollar, which was convertible to physical gold at a fixed rate of $35 per ounce. This physical anchor put serious limits on printing money. A government could only expand its money supply in proportion to the actual gold sitting in its vaults. But by the late 1960s, the United States was financing massive geopolitical and domestic programs, escalating military spending, and huge overseas investments. To fund these capital outflows, the government kept expanding the supply of dollars. The amount of currency circulating globally far exceeded the physical gold actually held in the treasury. When you've got more and more currency chasing the same amount of physical commodities, basic math tells you the currency itself loses value. 85%. That's exactly how much purchasing power the US dollar has lost since Nixon's broadcast. When Nixon realized it was mathematically impossible to honor foreign gold redemptions, he closed the gold window. In doing so, he removed the physical constraint on money creation, kicking off an era of unlimited fiat currency.
But how exactly do you print infinite money without anyone noticing? The answer isn't in a government printing press. Where?
To really get how the modern economy works, you've got to unlearn the biggest lie in the financial system. Most people assume that if you deposit $1 million in a commercial bank, the bank takes that exact money, stores it in a vault, and then lends it out to a borrower. That's complete fiction. The vast majority of the money moving through the global economy is created directly by commercial banks through digital ledger entries. Economists call this the quantity theory of credit. When you sign off on a $10 million mortgage to buy a property, the bank isn't going down to the vault to grab $10 million bucks. They aren't taking it from someone else's savings account. The loan officer literally just logs into their system and types the numbers in. In that exact millisecond, that massive pile of money is birthed into existence out of thin air. You sign a debt obligation, and the bank logs it as an asset. You hand that newly conjured cash to a developer, they use it to pay construction workers, and boom, the total amount of money circulating in the real world violently expands. This whole setup, disconnecting money from anything physical, completely wrecked the working class. The year 1971 marks the exact moment where your real wages permanently detached from how productive you actually are. Think about an artisanal baker who gets a new machine and suddenly bakes 10 times the bread. His physical output skyrockets. But in our fiat system, his paycheck doesn't go up 10 times. Inflation silently eats away at whatever tiny raise the baker gets. At the same time, the massive new profit margins get scooped up instantly by the people who own the capital. You work harder, you produce way more, but the actual economic reward for regular working folks stays totally flat. The whole game runs on the illusion of nominal interest rates. Think your savings account is making you money? It's actually making you poorer. Let's say you have $100. You put it in a savings account paying 2% interest. At the same time, inflation, the cost of living, is going up by 5%. Today, your favorite basket of groceries costs exactly $100, but you decide to wait a year and leave your money in the bank instead. Fast forward 1 year, the bank gives you your 2% interest. You now have $102. Awesome, right? Wrong. Because of 5% inflation, that exact same basket of groceries now costs $105. The brutal truth? You have $102, but the food costs $105. Even though your bank balance went up, your money buys less. You effectively lost 3% of your wealth just by letting it sit there. You were literally paying a hidden tax just for the privilege of holding your cash in the banking system.
So commercial banks are creating money out of thin air and taxing your savings. But that's just the minor leagues.
Wait until you see what the apex predators, the central banks, are doing to your retirement fund.
So while your local commercial banks are out here controlling the broad money supply through everyday lending, the real apex predators of the whole system, the central banks, they're the ones calling the big shots. They control base money, they move asset prices, and they do it through these massive asset buy-ups that you've probably heard of, quantitative easing. Now, here's where it gets interesting. You've got these enormous institutional players, think massive pension funds, the ones managing millions of people's retirement accounts, and they have strict legal mandates. Like, they are legally required to park trillions of dollars in ultra-safe investments that guarantee a steady, boring return. And usually, that means US Treasury bonds. But then, the economy tanks and the Fed steps in. They digitally print a mountain of fiat currency and just aggressively start buying up those exact safe bonds right off the market. And that does two things instantly. It wipes out the supply of safe investments, and it artificially crushes the interest rates on whatever safe assets are left, down to basically zero. And that triggers what's called the Portfolio Rebalance Effect. These massive pools of institutional cash are now completely stripped of their safe yields. They're backed into a corner. Because to hit the returns they legally promised to pensioners, these fund managers have no choice. They are forced to dump trillions into way riskier stuff. We're talking the stock market, commercial real estate, assets they would never have touched otherwise. So now, picture this. Wall Street is sitting on trillions in cash, and everyone rushes at the exact same time to buy a limited number of stocks. Prices go totally parabolic. And here's the thing, that surging stock price has nothing to do with the company's actual profits or some brilliant business move they made. The valuation just explodes, simply because there's too much printed cash sloshing around the system and investors have nowhere else to put it. So they buy blind. It becomes the ultimate detachment of the stock market from the real economy.
But here's the problem. Pumping trillions into the market creates an impossible mathematical trap.
The sheer size of these central bank buy-ups has permanently broken the normal rules of monetary policy. It trapped the Fed in a mathematical nightmare known as the Balance Sheet Trilemma. Think of the Fed like a guy managing a massive water dam. Theoretically, they want to hit 3 goals at once. First, keep a really small reservoir so there aren't taking over private markets.
Second, keep the water pressure out of the faucet perfectly stable so interest rates don't jerk around. And third, let the system run on autopilot so they don't have to manually twist the valves every single day. But when panic hits the market, the math falls apart. If you keep a small reservoir, your system is insanely fragile. The second the market begs for emergency liquidity, that small tank drains to zero. The faucet flow goes chaotic, and short-term interest rates spike to dangerous levels. On the flip side, if you try to keep the water pressure perfectly smooth but stubbornly refuse to build a bigger tank, you live in perpetual panic mode. You've got to intervene manually every single day, injecting and draining cash minute by minute just to keep the lights on. Realizing they were backed into a corner, central banks threw out the first rule entirely. They built a supersized reservoir and permanently flooded it with excess cash. Sure, this massive balance sheet means a sudden shock won't drain the system dry, but it permanently locked us into an era of massive, never-ending central bank intervention.
And if you think this infinite money glitch only affects Americans, you're dead wrong. What happens when this system gets weaponized against the rest of the planet?
And this infinite money glitch doesn't just stop at the US border. The dollar is the undisputed king of global trade. Foreign commercial banks are sitting on trillions in debt that has to be paid back specifically in US dollars. When a global crisis drops, credit markets freeze solid. And here's the fatal flaw. The European Central Bank can print euros all day long. Japan can print yen, but absolutely none of them have the legal authority or the machinery to print US dollars. Staring down bankruptcy and cut off from normal lending, these foreign banks are forced into a synchronized jumping off a building fire sale. They dump their best assets at massive discounts just to scrape together emergency dollars. When the whole world dumps assets at the exact same time, global valuations completely collapse, and the cost to borrow a dollar shoots through the roof. To stop the bleeding, the Fed steps in and opens up swap lines. They lend freshly conjured dollars directly to foreign central banks, but they don't do it for cheap. They take the baseline borrowing rate and slap a heavy penalty spread on top of it. This penalty acts exactly like a crazy expensive copay at the emergency room. It's designed so that foreign banks only use it when they are literally facing extinction. But look at the sheer hypocrisy here. If a regular, hard-working American needs a loan, you get ruthlessly vetted. You have to put up your physical house as collateral. You miss payments, they take your home. Your money is capped by the brutal reality of how many hours you can physically work. But when elite foreign banks face total ruin because of their own reckless gambling, the Fed takes on zero risk. The European Central Bank pledges some fiat euros, and the Fed just types on a keyboard, conjuring hundreds of billions of dollars out of thin air. If those commercial banks go belly up, the ECB eats the loss, and the Fed walks away clean. The guys at the very top get to use infinite digital money to socialize their losses, while Main Street picks up the tab. And it gets worse. This system is actively weaponized to siphon wealth out of developing nations. Based on data from the World Inequality Report 2026, there's a massive hemorrhage of cash flowing from the global south to rich countries. To protect their fragile economies, poorer nations are forced to park their savings in U.S. Treasury bonds, earning a pathetic 2% return. Meanwhile, Wall Street giants take their massive capital, dump it into those same developing countries, and extract returns of around 8% a year. That massive gap between the high yields rich countries extract and the pennies they pay out creates a structural siphon. It literally drains about 1% of total global GDP out of poor countries and straight into the pockets of rich countries every single year. The actual physical wealth being sucked out is nearly 3 times bigger than all the global charity and aid we send them. The game is rigged to enrich the top,
at the direct expense of everyone else.
But here's the sickest plot twist of all. This rigged game isn't just stealing wealth overseas, it's actively protecting rotting and dead companies, while forcing healthy businesses into the ground. Welcome to the zombie economy.
But the absolute most destructive part of this whole fiat money experiment is how it eats its own economy alive. It's completely corrupted the one thing capitalism is supposed to do right: clear out the dead weight. In strict economic terms, a zombie firm is a fundamentally broken, hyper-leveraged company that doesn't even make enough operating profit to cover the baseline interest on its own debt. In a normal, healthy free market, when the Fed jacks up interest rates, these zombie companies should drop dead. The higher borrowing costs should force them into bankruptcy, selling off their assets and freeing up workers to go join innovative, healthy businesses. So, when the Fed hiked rates recently to fight inflation, logic says these zombies should have been wiped out. But heavy-hitting research out of management science by Albuquerque and Mao in 2025 proves the exact opposite happened. These dead-end zombie firms somehow dodged the bullet, while totally healthy businesses got slaughtered. This is happening because of a shady banking trick called the zombie lending channel. The banks that originally loaned money to these failing companies are terrified. They know that if they hit the zombie firm with the new, higher interest rates, the company goes bankrupt instantly. And if that happens, the bank has to publicly admit they lost millions of dollars, which wrecks their own balance sheet. So, to hide their own massive losses, the banks secretly keep the zombies on life support. It's called evergreening. They hook these failing companies up with special backdoor deals, extend their deadlines, or just roll over the bad debt into a brand new subsidized loan, just to keep the zombie technically breathing. The data shows how insane this is. When the Fed hikes rates, healthy, productive companies get hammered by the cost of borrowing. They have to freeze hiring. They stop buying equipment. But because the zombies are secretly protected by panicked bankers, they barely have to cut back at all. The natural advantage a thriving company is supposed to have over a failing one, it totally disappears. The bottom line is devastating. Central bank rate hikes are supposed to flush out the losers, but because commercial banks are colluding to hide their own bad bets, tightening the money supply just ends up punishing the good guys. Innovative companies are forced to halt research and lay off workers, while structurally bankrupt corporate zombies get a free pass. It clogs up the whole market, it drives up the cost of everything, and it guarantees that our society's resources are wasted on rotting companies instead of funding actual innovation.
So, the banks are hiding their losses, the zombies are surviving, and you're paying for it. But how does this house of cards collapse? The idea of money for nothing isn't just some crazy economic myth. It's the actual operating system of the modern financial world. Instead of a level playing field, we have a system structurally designed to funnel wealth upward. It consistently shields the top fraction of earners from the consequences of economic downturns, ensuring that while everyday people absorb the impact, the most insulated capital holders continue to profit. But while Richard Nixon conquered the global economy with the stroke of a pen, today's empires are built on something way more dangerous: invisible algorithms. To see how this exact history of wealth extraction is repeating itself in your smartphone right now, click here.
Thanks for watching. Don't forget to like, comment, subscribe, and turn on notifications. Thanks for your support. See you in the next one.